Hi guys, Peter Harper, Managing Director and CEO of Senior Advisors. For those of you who are not familiar with the business, we're a multifamily office and we advise foreign family offices and individuals on US direct investment and mergers and acquisitions. So today we're going to talk about the next section within our series on whether your foreign trust is a Grantor trust for the purpose of the Internal Revenue Code. Specifically today we're going to talk about reversionary interests and what it means for a US-based grantor to have a reversionary interest in a foreign trust. When you can have one and in a trust deed, and what it means if you do. So what is a reversionary interest? A reversionary interest is an interest in a trust whereby the original person that settles the trust, whether that's as the settlor or as a direct contributor to the trust, ceases to have any real interest in a trust for a period of time until somewhere down the track a contingent event happens, such as the death of a beneficiary or some other life event, and an entitlement to either income or capital reverts back to that individual, right? Yeah, in the old days when trusts were set up as a way of transferring assets to women who couldn't own property, this was a real way for fathers to pass assets down to his daughters. Under the code, these provisions apply both to a straightforward transfer where there is a direct provision of an asset to a third party, or to circumstances where a trust provides a broad amount of discretion to a trustee in favour of a broad amount of beneficiaries. And that's where I particularly want to focus today, because most of our clients that have foreign structures have them in discretionary trusts whereby the trustee has the discretion every year to distribute income and capital to a broad range of beneficiaries, right? So in that particular example, if you have a situation where you have a US person that is defined as a grantor under the code, and the provisions allow for the trustee to distribute all or none of the income or capital to the US beneficiary that is also the grantor, that is sufficient for that taxpayer to treat it as though they have a reversionary interest in 100% of the trust assets, thereby making the structure a Grantor trust. If you're unlucky enough to get yourself into that position without proper planning, the outcome of that is that any income gains or losses generated by the structure are automatically attributed to that beneficiary, regardless of where the trustee decides to distribute the income. Hope this is helpful. Next week we're going to touch on section 674 of the Internal Revenue Code and how that can impact foreign trusts. If you're interested in learning more, dial in then. Ciao.